Hi. At Talaria, our purpose is to help people and communities enjoy a more certain financial future. For nearly 20 years, we've been doing just that through our unique and alternative approach to global equity investing. Before we get into the how, it's important to discuss why we do what we do. At its core, we believe investors should be paid for taking equity market risk. And our investment philosophy is based on the fact that the volatility of share prices is often higher than the volatility of corporate cash flows. We seek to exploit this difference. The source of this difference between a share price and the fundamental value of cash flows is rooted in behavioural biases. Examples of such biases include short versus long-term focus, a recency bias, extrapolation, and modelling assumptions that lead to oversimplification. With this in mind, our portfolio is built with an integrated process which combines fundamental bottom-up research to identify companies we want to own and a unique implementation process which rewards investors immediately for taking market risk. This approach achieves three key outcomes: consistent income, less market risk, and lower portfolio volatility. We'll go into more detail about how that works soon, but first, let's drill down into the initial part of the process, the research. First up, a high conviction approach is taken to construct a concentrated portfolio of global equity investments. The process begins with excluding certain companies based on ethical grounds. The first filter we apply is the company must have a developed market listing and have a market capitalization of at least $5 billion US. This leaves an opportunity set of around about 1,800 global securities for consideration. This initial screen narrows down all global equities ex-Australia into our investable universe. We then screen these companies within sector and region based on 7 unchanging elements. However, the relative importance of these elements changes over the course of the stock market cycle, which is reflected in the screen. These 7 elements can be split into 3 general categories: valuation, fundamentals, and risk. Taking the top decile of stocks within each sector, within region, leaves us with a subset of around 180 stocks on which to focus our research efforts. The universe of 180 stocks is then prioritised to the top 80 or so, which are allocated to members of the investment research team to conduct bottom-up stock research. The primary aim of the analyst is to determine our best estimate of what cash returns a company can generate in a normalised environment. This is done through analysing company annual reports and financial statements, typically going back a minimum of 10 years. Considerations include revenue and earnings drivers, accounting quality, sources and uses of cash, capital requirements for the business on an ongoing basis, and the costs borne by the business, such as pension, litigation, restructuring costs, and any remediation and environmental costs. This analysis is also undertaken for the nearest peers to understand the industry context in which the potential holding exists. When valuing companies, we use a number of methodologies. For example, earnings multiples, sum of the parts, enterprise value to investor capital, as relying on a single valuation methodology can lead to poor investment decisions. It is at this next stage that ESG data are integrated in the investment process. ESG factors need to be measurable, available, and material, and we have 38 criteria that are taken into account when assessing a potential investment. In the event that we're unable to determine certain pertinent data points, we'll contact the Investor Relations Department of the company in question to confirm the data. The research process typically takes 4 to 7 weeks ahead of an idea being socialised in the wider team. Once stocks have successfully made it through this entire process, an initial position in the company is instigated, which leads to part 2, implementation.